구물리아 선임 애널리스트님께서 컨테이너선 시장 동향과 전망을 주제로 발표해 주시겠습니다. I'd like to invite Senior Shipping Analyst Rinaldi Gumulya from Alphaliner, and he will be presenting on the topic of container market trend and outlook. 여러분 무대 위쪽으로 모셨습니다. 큰 박수로 환영해 주시기 바랍니다.
Good afternoon, everyone. First of all, let me say thank you to Kobc for inviting Alphaliner today, and hopefully you guys are having fun for these 2 days. And as we are nearing the end of it, I ask please bear with me. I'll try to keep my message short and won't leave you guys for long. So before I start, let me share a little bit about myself and Alphaliner. My name is Rinaldi. I'm the lead analyst for Alphaliner in Asia. And Alphaliner itself is the leading provider of market insight and data information focusing on container shipping. We are one of the vertical for Access Marine, which also offers dry bulk and tanker products. Currently, we have more than 200 people globally working around the clock to maintain our database. We are present in Europe, Middle East, Asia, and the USA. So for today, I'll share something about the container shipping market, how we are today, and hopefully I'll share a few factors that might affect the outlook in the coming few years. For the agenda today, I'll start with showing you some key numbers, some charts to show where the market is today and how we get where we are. And of course, everyone knows disruption is the new normal today. I'll delve a bit into that. Of course, part of it is congestions and delays that we are facing. And lastly, of course, the massive order book that everyone is interested in. So, some key numbers. Let's compare 4 years ago. Basically, in the brief period of 4 years, the liner sector has seen a growth of about 8 million TEUs in global capacity. And that is huge, considering that in the decade before that, the average growth per year is only about 1 million TEUs. And you can see the year-on-year growth is still strong as per October 2025. However, all of this massive tonnage that has come to the market in the past, mostly started from 2023, has been fully absorbed by the market, either from the disruptions, the Red Sea diversion, and everything else. As you can see, the vessel that is being idled is basically practically zero. So all fleet are, we can say, fully employed. Any of those idling basically means it's just pure out of operational necessity. And the order book is huge and continues to grow even until now. To better illustrate that, let me show you this. So basically, the 33 million TEUs is the biggest ever container fleet that we have ever seen in history. And the order book, although in terms of ratios, order book to fleet ratios is quite high, not the highest ever, but in terms of absolute value, it is the highest ever. While the average age of container ship now is about, let's say, 13 years, it's not considered young, but it's not that old as well. So just some quiz for you guys. What percentage of global fleet is being controlled by the top 10 carriers today? Short answer, the market is fully consolidated. The top 10 carriers control about 3/4 of the entire global fleet. And just a short advertisement, this is our top 100 benchmark. You can get this, you can go to Google and just Google Alphaliner top 100. You'll get to this page. It is free. We update that regularly, daily. If you see the top 10 carriers now, I want to focus on that. So the top 10 carriers now are basically divided into about 4 tiers. MSC, that recently reached 10 million TEUs, becomes a bit of a super carrier by itself, which is not strange considering their ambition has always been able to support their own global fleet, covering globally by themselves. And on the second tier, of course, you have Maersk, CMA, and COSCO. And in the mid section, you have Hapag-Lloyd, ONE, and Evergreen, while HMM, Zim, and Yangming made up of the last three. And then if you look, 84% is big, but if you consider MSC by themselves actually control about 20% of the market. So just something to show you. It's a bit hard to read, but each color represents different trade region. So, and just by looking at the colors, you can see the colorful bars. Only the top 10 carriers nowadays can be considered a truly global carrier. Once you go below that, you can rapidly see it is mostly regional coverage. So this graph I have for you guys just to show the development or evolutions of the global fleet itself. The blue line, the blue graph is basically the total fleet starting from 2005, when it was about 7 million TEUs. It has grown by about more than 5 times, basically, in the short span of 20 years. Like I said earlier, the average growth before 2003, where the arrow pointed, it was about 1 million TEUs per year, and since then we have accelerated to about 2 to 2.5 million TEUs. And as I mentioned earlier, the highest order book to fleet ratios was actually in 2008, where it was about 60-something%. But then after that, of course, we have the financial crisis, and it led to a decade-long decline of ordering vessels in the container sector. So again, even though the order book to fleet ratios now is only about half of 2008, but in terms of absolute value, we are the highest ever. So that could be a warning sign, basically, in what the market have to face in terms of capacity in the next couple of years. This is just something fun, just to show you, illustrate how big MSC has gotten. If you take MSC 7 million TEUs now and transport that back to 2005, we can clearly see that MSC size now actually encompassed the entire container market back in 2005. Now, disruption as the new normal. We've shown this graph quite a few times over the past couple of years, just to show you what type of disruptions that we are facing, basically, the global trade. Of course, we have pandemics, COVID, we have the Houthis attacking merchant vessels in the Suez that led, of course, to the, rerouting towards Africa. We have Ukraine war, we have recessions looming, we have labor strike in the US last year. Climate change, obviously, sent a lot of vessels, containers to the sea as well. So what has changed this year is basically the Trump's organizations. He is, by any means, is a one-man disruption towards the global trade. Of course, the US has, and their partners have managed to postpone the IMO net zero framework. And of course, the trade war with China, which is, again, just recently been postponed when he agreed to meet with President Xi in South Korea and in China. But all of that pause does not give us stability or certainties. That actually leads towards more uncertainty. So that does not help global trade at all. Just to illustrate the impact of the US tariff port fees, if they were implemented as per fleet in September. We calculate this based on the fleet of Trans-Pacific in September. In total, the top 10 would incur about more than $3.3 billion per year if they have to maintain the same fleet that they deployed in Trans-Pacific in September. And of course, the biggest victim would be COSCO, which is obviously a Chinese shipping line, where HMM, of course, with its fleet combination, they would manage to avoid the Trans-Pacific tariff. Now let's focus on the congestions and delays that have been happening. Like I said, disruption is the new normal. So when all the disruptions started, when the rerouting started, we predicted it would eat up about 10% of the global fleet. But of course now we revised that, taking into account the direct and indirect impact. The direct, of course, is the additional about 2 to 3 vessels per Asia-Europe loop. And the indirect would obviously be the increasing feedering activities within the Med, in the Middle East and India to cater for those ports that were being dropped by the Asia-Europe loop. So basically now we predicted is actually closer or actually more than 15% of the global capacity that is being eaten up by the rerouting of Africa alone. That's why when I showed the earlier figure, you can see even with the massive 8 million TEUs coming in since 4 years ago, all of that are still being absorbed by the market. And another thing that eats up capacity, of course, is the increasing port waiting time. So we have calculated the average waiting time in 2020 to 2021, and within the past 2 years, the average increased by about 10% globally. But of course, this increase does not apply everywhere at the same time. Each region would have different impact to it. Let me show you some example. Los Angeles, which is famous for being the most congested port during COVID, where in headlines, in news everywhere, you see about 200 ships waiting outside of Los Angeles. In 2021 to 2022, we saw an increase about 500%. They have been quite stable, but obviously on the seaside, of course, they have problem in the rail congestions and everything else. And Shanghai, being in China, volume keep on increasing. It does not help them, of course, with the climate change, with the bad weather as well. You can see the global trend for Shanghai is actually on the rise, more and more waiting time. While Singapore, while they do face a bit of an uptick here and there, but PSA has managed to do quite a good job being efficient and managed to push down the overall trend to minimal waiting time. And Europe, obviously, Antwerp, we see is quite volatile. And this is the last example I gave because let's say if they do open up if carriers continue to cross the Suez in mass again, of course, we will see a bit of congestions in Europe impacting that. Now let's talk about the massive order book. So again, another fun trivia. We have 10 million TEUs record order book. If you put those boxes on a train, how long do you expect that train will be? Take into mind, let's take an example, just 1 TEU would be about 6.6 meters. That would give us about almost around the equator twice. So that shows you how big the order book currently is. Now this graph shows you the timeline of deliveries. In the dark blue is the delivered vessels so far, and in red is the scheduled to be delivered in the next few years. So I just want to explain something. So usually container ships, before all of this hoo-ha, would take about 2 to 3 years from ordering to the delivery of the vessels. But as we can see now, the delivery actually stretched to about 5 years, 4 to 5 years. So take that into account when we talk about, yes, 10 million TEUs is huge, but of course the delivery is being stretched a bit more compared to normal. But then again, another caveat is that if you look at 2027 and 28, it is still a huge amount. Each year would give you more than 3 million TEUs of fresh tonnage coming into the market. So overall, it will still be a challenge for the carriers to absorb all of this capacity without reducing through other means. Now, this graph is showing you, so the white dot would represent the conventional powered vessels. And the x-axis shows you the age, the younger to the left, the older to the right, and the y-axis represents the capacity. The bigger it is, obviously, more to the top. So as you can see, the orange dot and the yellow dot for LNG and methanol, you can see the newly delivered ships you can see almost all size segments are being delivered of the new alternative fuel, especially if you see larger than 15,000 TEUs. There's only a few conventional vessels coming in the past year. But if you look at a smaller size, obviously about 3,000 TEUs, you can clearly see it's still dominated by conventional vessels. Although we do start hearing people like CMA-CGM started ordering smaller 1,700 TEU ships in India for LNG. Now, you can ignore the numbers because we took this a bit earlier from the year, so it's slightly different, slightly smaller than the first page I showed you earlier. But I want you to focus more on the pie chart itself. As you can see, the current global book, even though the alternative fuel vessels has started to come in quite rapidly, it is still a small segment of the entire global fleet. It is, at least for now, it only takes up about 10%. Now, in comparison, let's look at the order book. Same, focus on the pie chart. You'll be able to see LNG in orange and methanol in cream color. Both of them take up about almost 80% of the entire order book, while conventional is only about 20%. Same with the size, the size as well. Like I've mentioned earlier, if you look at the larger size ships, the order book, you can clearly see it is being dominated by the LNG and methanol, while the smaller one, of course, now with the new order that started to come in before we produce this slide, it might change slightly, but it is still roughly being majority conventional. Now, on this slide, I want you to focus on the trend, because LNG, on the left side there, you can see LNG peaked somewhat in 2024, the order of LNG, but it has dropped out slightly, and interestingly, same with methanol, and slight uptick on conventional. And again, I said, the main problem with decarbonization is not about the asset class itself, because the asset has been ordered by almost all the big carriers. And for example, Maersk CMA has run a fully staffed services with all LNG or all methanol vessels. But the main problem is the tethering issue, is the availability of clean fuel. So the pause of the IMO net zero framework does not help with that. I would suppose with the delay on that, fuel provider would also be a bit slower in producing more and more clean fuel. And I suppose this trend would still continue a bit more until it reverses, when we all settle down, have a more clear global framework on how we approach decarbonization. Now, this is the delivery schedules per top carriers, and divided, of course, again by propulsion type. I'll just talk about a few of them. MSC is a bit late into the game because obviously they are one of the biggest retrofitter of scrubbers back in 2020. So they were waiting, of course, more on conventional fuels and just using scrubbers. But once they joined, they fully go into LNG. While Maersk is the other way around. They started with methanol, but sometimes in 2022, they started to diversify into LNG. While CMA-CGM is an early adopter of LNG, but they do a bit diversify slightly using methanol. While COSCO, the Chinese, seems they are, at least for now, they are betting solely on methanol vessels. Again, fun facts. Everyone knows that carriers make a boatload of money during COVID. Just an example, in 2021 alone, they make more than 100 billion. That has not taken into account MSC, of course. They are not a publicly listed company, so they don't really have to divulge their earnings. So let's see, so far, how are we performing in the container market? In the first half, or at least until August, CTS says that we are growing about 4 to 5%, the entire market, the entire global throughput, basically. And as you can see, for the carriers themselves, it is, if you took the average, it is kind of similar to what CTS has provided. The biggest gainer is Hapag-Lloyd, about 11%. But of course, that is mainly because they switch alliances and they want to gain market share. And that is shown because if you look at the average freight rate, it is actually slightly lower compared to the other top carriers. COSCO hold the geographical advantage because, of course, China export continue on this year quite strongly, even though there's a bit of disruption to the US, but of course, to the rest of the world, it is still strong. And they are selling their being stable in an ocean alliance that doesn't change this year, basically. So for BCOs or shippers that want stability, they would tend to go into ocean alliance. Well, Yangming is the exception in this context because they actually lost some volume, but that was because they are trying to get higher yield cargo, and they are actually rejecting lower yield cargo. Let's see if their plan plays out at the end of the year. Now, talking about outlook, let's take a step back and take a look in the past 4 or 5 years. This is basically just a chart of the freightos, basically, the freight rate, representing freight rate. Everyone knows the boom during Corona and post-Corona. But then, of course, when we are approaching 2023, everyone was like, you know what, this is the end, which is kind of true if you see the market actually bottom out. However, of course, Israel and Gaza conflict happened, and Hamas started to attack vessels. That leads to the diversion towards Africa, and that leads to our second rally on the freight rate that continues until somewhat early this year. And again, this year, everyone predicting that the year would be a low one, but again, we have another disruption called Donald Trump. When his second term started, you can see there's a huge drop, obviously. But again, when Liberation Day, when he announced the tariff, that was we have a slight peak on that. And then, of course, during the pause, we see a very small uptick, but then that uptick has been wiped out. At least if I look at the last week or this week, freight, all the slight gain is actually gone now. So let's just zoom in slightly on Trans-Pacific. Overall, the freight rate in Trans-Pacific itself is similar to the global movement, especially when it's impacted by the US government's policy. It's just a little bit sharper if you see the up and down. This is the prime example. I'll show you because I have the figures here. In September, it started to drop, but then again, of course, it started to gain in November. But then, as of last week or early this week, that gain has actually been gone again. So the market is still very, very volatile. Now let's talk about charter rates, which is one of the big components of fixed costs for carriers themselves. As you can see, charter rates was sky high during COVID, but it has gained still a bit since the Red Sea incident happened, and it still maintained that same height. I'll show you a clearer picture by putting them side by side with the movement of spot rate. As you can see, initially the correlations has always been strong between charter rate and spot rate. You can clearly see that during COVID and during the drop, which is, even though charter rate dropped slightly slower compared to the freight rate, it is still dropping. But however, since Red Sea, we have seen the correlations kind of taper off. You see now freight rate has dropped again. However, charter rates continue to be high. And this will pose a problem for the carriers because they would have an increasing cost to face, while the freight rate would be quite low. Now, facing next year, everyone says about overcapacity, which is kind of true. So carriers would have a few tools in their disposal to face overcapacity. First, of course, is by laying up the ships, which is called idle ships that we counted every 2 weeks. As you can see, it has virtually been none. If you see the spike during COVID, yes, slightly. And then since then, supply chain has been stretched fully. Of course, a bit of an uptick during 2003. Like I said earlier, people were expecting the market to go down, so I didn't go up. It was very normal. But since then, it was practically zero. And of course, another tool would be scrapping, because in the past 5 years, since we've had COVID and supply chain being very tight, carriers and owners are not really scrapping any ships. That will be very minimal. So the average age of container ship is usually about 25 years. But in the context of, because you know what, we are approaching decarbonization effort as well. So let's take 20 years, let's say, because you know all the ships are expensive to retrofit, right? So let's just take the highest chance. If let's say the market is in overcapacity, then carriers or owners would likely just scrap older inefficient ship for younger ones that they can just build. So we total for container ships that is about 20 years, there's a potential of about 4.3 million TEUs to be scrapped. But be warned, of course, this number looks quite significant, but scrapyard slots are limited as well. Earlier, I've heard from some colleagues that from the scrapyard earlier that says there are already carriers and owners that start to forward contract to scrap their vessels because they are expecting to be scrapping and they want to secure a slot from now. So we will see scrapping increasing, obviously, but of course there will be limit to it because of the physical limitations of the yard themselves. Of course, this is another tool that the carriers can use and have been using. Quite popular is slow steaming, slowing down their ships. As you can see, even before the diversion through the Red Sea, we can see carriers have been slowing down their vessels from about, let's say, 16.5 knots on average to about 15 knots. And even during that time, carriers have been talking about slowing down further to about 40 knots. So if you see a ship speed up slightly during diversion via Cape of Good Hope, of course, to catch up with schedules and everything else. But of course, you can see carriers have started to slow down again, but they still have quite a safe buffer, about 2 knots to play around. That could give you another, I don't know, maybe about 10% absorbed capacity. So this is the most popular chart that we usually have, is the evolutions of the container's earnings, basically the top carriers' earnings. As you can see, let's take a step back, look at the past decade. Container carriers have been making almost no or basically making losses during the past 10 years. They are basically subsidizing the global trade. And the only time where they are making money is during the peak COVID, when it was a lot of money, like I said, in the hundreds of billions of dollars. And now we have our second peak, which is during the Red Sea, and now it has actually dropped quite significantly. Just this morning, my team just finished our reports on the third quarter EBIT, and it is actually a slight uptick from the second quarter this year. But that, I would say, is just temporary. Our team still expect next year to be continuously downturn. Obviously, like I mentioned earlier, like the charter rate, carriers will face increasing costs. But of course, with the lower demand that everyone is expecting next year, margin will fall, overcapacity come in, freight rate will continue to fall again, and that would be our prediction for now. But of course, it depends on what happens with the US-China relationship, with the US tariff, trade wars, and of course, if there's any more black swans, pandemics, or anything else. Now, before I move on to my conclusions, just something, food for the mind, basically. Because we've noticed since the first Trump administration, China has actually started this China Plus One policy, where they started to diversify, elongate their supply chain. And of course, with the second US presidency, he started the tariff war, the trade war. And that really accelerates the diversifications or the regionalizations. And so far, we can see intra-Asia, regionally, India have been benefiting from that, from increased traffic, increased volume. And of course, don't forget, because of the tariff war, a lot of people are also, of course, finding different ways to ship either Chinese-made cargo towards South Asia or India towards the US themselves. So, our prediction for the upcoming years. Like I said earlier, we predict, of course, scrapping will increase because overcapacity will come. But then, scrapping alone won't be enough, basically. That's what we are saying. So overcapacity would be coming. And that would put pressure to the freight rate. And of course, the Red Sea. Everyone is asking this. But we would say the carriers are not too keen on returning to the Red Sea in the short term, really immediately. I think they will take a wait-and-see approach. If any of you guys read the news recently, there's a news about Maersk pledging returning to the Suez in December. We've received news from Maersk that apparently that is not true. So basically, they will continue what they're doing now. They will only return to the Suez when it is fully stabilized. So we would expect maybe not in the near future. And of course, slow steaming carriers will continue to use that tool to absorb more capacity that will be coming. And of course, that would help them with the fuel consumption and the carbon taxes as well. And the next one would be, it depends on the discipline of the carrier themselves. During COVID, we see carriers being disciplined for the first time, where they are not chasing market share, but they are trying to maintain freight rate. So it will depend. If carriers can maintain their discipline, then they would need to cut services, they would need to lay up ships to prevent I don't think they can raise freight rate, but at least to slow down the decline of freight rate. And lastly, of course, like we said, the sea-borne asset is not really the problem in how we continue to evolve the size, grow. It's more on the land side. We need more investment to make the land side more efficient and can handle more disruptions. So if there's any disruption happens, congestion will definitely happen. So we would actually see, as I've shown in the chart earlier, port waiting time would continue to be high, and it would be quite sensitive towards any disruptions. And that's it from me. Thank you very much. If you have any questions or you disagree with some of my statement, please feel free to chat with me, and I will be more than happy to discuss more with you guys. Thank you very much.
네, 감사합니다. 알파라이너의 리날드 구물리아 선임 애널리스트께서 오늘 컨테이너선 시장 동향과 전망을 주제로 발표해 주셨습니다. 여러분 다시 한 번 더 큰 박수 부탁드리겠습니다. 네, 이어서 7번째 발표해 주실 연사님 무대 위쪽으로 모셔볼 텐데요. 7번째 발표는 Kpler의 하니프 카마르 수석 애널리스트님께서 해주시겠습니다. 드라이벌크선 시장 동향과 전망을 주제로 발표해 주실 텐데요. I'd like to invite Senior Dry Bulk Freight Analyst Hanif Kamar to the stage for the next presentation. He will deliver presentation on dry bulk market trend and outlook. 여러분 무대 위쪽으로 모셨습니다. 큰 박수로 환영해 주시기 바랍니다.
Hello everyone, my name is Hanif. I'm based out of Malaysia and I look into the dry bulk freight research at Kpler. So I work with a team of dry bulk analysts, so each of us specialize in one commodity. So that includes your major and minor bulks, and so I cover the shipping. So I'll give you an outlook on the dry bulk market as well as shipping, and we'll be covering 4 sections. So the first one will start with looking how dry bulk carrier earnings have performed this year, and I'll give a brief outlook on what we think will happen next year. Then we'll look into how these commodities are shaping the demand for our dry bulk tonnage, and then we'll look into the supply side developments. We'll discuss what we expect, what kind of growth we expect for the dry bulk fleet, and what has been developing on the fleet supply side. And finally, I'll conclude my slide with giving what I think will happen next year. So, chart on the right that you see right now is the dry bulk carrier earnings. This is assessed by the Baltic Exchange. Each line represents one vessel segment. So, the Capesize earnings has been leading the dry bulk freight market, but the smaller vessels have been lagging the demand that we saw in 2024. So as a result, you see a divergence between the earnings. So the Capesize earnings rise higher, but the smaller vessel earnings, they've diverged away from the larger vessel. So for example, the Capesize 5TC, during the third quarter, it was the second strongest quarterly level that we've seen since 2021. So it averaged at exactly $24,684 per day. And I think the C5TC will end the fourth quarter very strongly as well, with the upturn in Guinea bauxite exports. And the smaller vessels, on the other hand, although we've seen the smaller vessel earnings rebound in the third quarter, I think there will be more downward pressure for the remaining of the year. Additionally, there's a strong relationship between the Capesize vessels and also the smaller vessel, which is the Panamax, such that a firm Capesize earnings can also lift the Panamax earnings, which we'll discuss later. Now, on the other hand, although we have seen strong time charter rates, also known as the vessel earnings, on the Capesize market, you're not seeing the same strength in the dollar per ton or the spot voyage rates that the charterers pay for. And finally, as Rinaldi mentioned just now, there have been a lot of geopolitical instability that has caused supply side inefficiencies. These have actually support earnings for the smaller vessels, but I also see them as a downside risk if these inefficiencies taken up and improve. I'm going to take a look at each vessel index and what has been driving them this year. So let's start with the Capesize. So I've mentioned that Capesize earnings have performed strongly this year. So what has been driving it? So look at chart on the left. So chart on the left is the Capesize earnings in terms of the Atlantic earnings, Pacific earnings, and also the Atlantic premium over the Pacific. So a strong performance in Atlantic earnings have been driving the Capesize index this year. Over the last 10 months, the premium of the Atlantic over the Pacific was nearly triple than it was last year at $1,064 per day. So the reason for the performance in the Atlantic earnings is, number one, there's a small growth in the regional trade volume on the Atlantic basin, but it's also because of the disproportionate weighting of the Atlantic route within the Capesize index. So what I mean is, the volume of regional trade in the Atlantic is much smaller than the regional volume in the Pacific, but the weighting of both routes are equal, 25%. So even if you see an uptake of trade activities on the Atlantic basin, you'll see this driving up the Capesize index. And I think this trend will continue next year because of higher regional trade in the Capesize market on the Atlantic basin. Now, I've mentioned that time charter rates, especially for the Capesize, it has been good, it has been better. However, the dollar per ton rates, this is the spot voyage rates that the charters pay for, it's not seen the same strength. Let's look at chart on the right. So chart on the right is the spot voyage rates for shipping iron ore. So each line represents one route. Let's take a look at the rates for Tubarão to Qingdao, for example. During the third quarter, the rates range between $18 to $26 per ton, which is much lower than what we saw last year over the third quarter. So last year over the third quarter, the rate was $23 to $32 per ton. Now, to understand why the spot voyage rates have not seen the same strength is we need to understand how this is calculated. So time charter earnings or the time charter rates or vessel earnings, it largely reflect the supply and demand of vessels. But the dollar per ton rates, it's calculated based on the time charter rates and also other ancillary costs for running the ship, like bunker fuel. So in other words, the dollar per ton rates reflects the time charter earnings and also the bunker fuel costs. I'm very sure that you're aware that bunker prices have been in decline. So for example, the Singapore 380 centi-stoke price in October was lower by 21% compared to last year. And I think this trend will continue next year because we expect lower bunker prices to keep putting pressure on the spot voyage rates. I have mentioned that firm Capesize, there is a strong relationship between Capesize and also the Panamax vessels because firm Capesize earning can also support the smaller vessels, which is your Panamax. So look at chart on the left. So chart on the left is the Capesize to Panamax earnings ratio. It is unitless, and I've calculated this by dividing the Capesize 5TC with the Panamax 5TC, and each line shows 1 year. In June this year, the ratio spiked to the highest level since 2024 at 2.45. So 2.45, this is actually above the long-term average of 1.21. So what that means is the larger vessel, the Capesize, time charter rate, is priced at a significant premium to the smaller vessel. The reason for this is that they rise above the long-term averages down to two factors. Number one, Capesize demand has been better, but it's also suffering from reduced vessel supply. And second reason is Panamax demand weakness because of slower seaborne coal trade, plus better fleet supply efficiency for the Panamax vessel. So the Capesize market, briefly, they have been benefiting from more trade volume this year because of new iron ore projects coming online, especially out of Australia. For example, the iron ore bridge by FMG. And a huge proportion of Capesize vessels are entering dry dock to go for their periodical maintenance schedule. Panamax vessels, on the other hand, they have been suffering from slower seaborne coal trade. I'm very sure everyone knows about that. But at the same time, the vessel supply has been benefiting from better port efficiency, and this is very evident at Brazilian grain ports, which we'll touch in a bit. So chart on the right shows the Panamax earnings, 5TC. Each line represents 1 year. So for the first 6 months of 2025, Jan to June, Panamax earnings have been 33% lower than they were in 2024. And mentioned this is a result of slower seaborne coal trade, which also declined by 8%. For your information, 55% of Panamax shipments are driven by coal. So slower coal trades have left more Panamax vessels competing for fewer shipments. So as a result, it pushed earnings lower. At the same time, I've mentioned that Panamax vessels have been benefiting from better fleet supply, and this is evident at Brazilian grain ports. For your information, 80% of Brazilian soybean and corn exports are carried on your Panamax vessels. So usually when there is a rise in loading activities at Brazilian ports, congestion happens, and that ties up supply and also support earnings. However, that has not been the case this year. So this year, Brazil exported an outstanding number of soybeans because of better demand in China, but the congestion level at Brazilian ports have been below 2024 and also 2023. So that means, Panamax vessels are not suffering from tighter supply at Brazilian grain ports. However, although we see weakness in the Panamax vessel, remember I mentioned that the Capesize market strength can also provide a floor for Panamax earnings, as whenever the earnings ratio that you see on the left, whenever the earnings ratio rises above long-term average for a sustained period, it increased the chance of cargo splitting, for example, splitting one Capesize stem onto several Panamaxes. Now, how have smaller vessels been priced in higher trade volatility? So chart on the left is the Supramax average earnings and also earnings on coal routes. So Supramax vessels are your smaller vessels. These are your geared vessels. So like the Panamaxes, a lot of Supramax demand is also concentrated with coal. So coal make up 20% of international Supramax shipments. So lower coal trades this year have pushed down Supramax earnings by 16% lower than they were last year. And additionally, lower Indonesian coal imports also caused a divergence between the time charter rates on Indonesian coal routes. As you can see on the chart, I've shown 2 coal routes, one to China and also one to India. So in the past, the difference in terms of rates between these 2 routes were only 4% in 2024. But this year, that difference grew to 21%. So this is as a result because China has been taking much lower Indonesian coal, and as a result, it caused a divergence in the Supramax coal voyage earnings. And I think this trend will still continue in 2026 as Indonesia is in structural decline in terms of their coal exports. A chart on the right is your handy-size earning. Each line represents 1 year. It's also a geared vessel. It's the smallest vessel among the 4 dry bulk carriers. Handy-size earnings also struggled to outperform the 2024 levels. That is until the late third quarter. But compared to the larger vessels, handy-sized vessels, they benefit from more diverse source of demand. Last year, the Mediterranean and the Black Sea, South America and also East Asia, these 4 regions make up 42% of handy-sized demand. So steel export is an important source of demand for handy-size, especially in the Pacific. But this is going to face a downward pressure because you're seeing more trade barriers on Chinese steel exports. And in the Atlantic, the US also put up trade barriers to its steel exporters on Brazil and EU. So you're going to see steel trades on the handy-size on the 2 basins contract next year. And there's one more downside risk for the smaller vessels, and that is if earnings for the smaller vessels, the Panamax and also the Supramax weaken. So when you see weaker earnings on the larger vessels, you'll see that they become the cheaper vessel to charter and they can slash demand for the smaller vessels. Now, I'll be covering what are the dry bulk demand that will shape our dry bulk carrier tonnage next year. So chart on the right is our projected seaborne trade growth, where you can see the iron ore and bauxite will increase next year on a higher base this year. Secondly, although weak Chinese steel production have been putting pressure on global steel production, we expect better prospects for other major markets outside China. And thirdly, growth in West African iron ore exports, these will outpace other markets, other suppliers, and this will give China some advantages to drive the dry bulk market. We expect seaborne coal trade to rebound by 14 million tonnes in 2026 because of better outlook in China. What they've done is they are trying to rebalance their coal supply and production. And also we will see more coal importers competing for Pacific market next year. And finally, trade barriers and high domestic demand within some key grain markets will be exerting downward pressure on smaller bulkers next year. So let's take a look at each commodity. So lower Chinese steel production have continued to pressure global output. So chart on the left is the annual change in global and Chinese crude steel production, where both productions had declined in the past 2 years. And I think they will decline again this year. So slower Chinese crude steel production may not necessarily mean slower seaborne iron ore trades. And this is because of 2 factors. Number one is crude steel production. The prospect for crude steel production outside China will stabilize in 2026. This is coming from emerging economies such as India and Vietnam. We expect both steel production to increase by at least 5% on the year. Second reason will be the decline in Chinese crude steel production will first hit high iron ore producers and also exporters. So both factors will come at a time when there is an increased supply of seaborne iron ore. So as a result, we will also see I'm also expecting iron ore price to decline below $100 per ton next year. So chart on the right is the annual change in seaborne iron ore exports, where you can see growth in 2026 will be driven by supply coming from West African countries. We expect West African iron ore exports to grow by 30 million tonnes to reach 70 million tons in 2026, where a quarter of this will be driven by, you can take a guess, the Simandou iron ore. You're aware that Simandou iron ore is heavily financed by the Chinese entities. So that means export demand will be concentrated in China. And we expect the Simandou iron ore exports to rise by 23 million tons in 2026. So in addition to the Simandou project in Guinea, several other projects in West Africa will also add to seaborne iron ore supply. For example, Mauritania, they aim to ramp up their capacity to 40 million tons per annum by 2030. Sierra Leone, the Tankolali projects, they expect to ramp up, they expect a full nameplate capacity by 12 million tons per annum, and a long-term target of 30 million tons per annum by 2030. And Liberia as well, the ArcelorMittal projects, they target to ramp up by 20 million tons per annum by 2026. So higher iron ore exports will not just support the larger vessel Capesize demand, because the Liberia project is largely shipped on the Supramax vessel, and this will support the transatlantic trade, as a lot of the volume coming up from ArcelorMittal's projects are catered for their steel mills in Europe. So overall, seaborne iron ore exports will increase by 24 million tons to reach 1.74 billion tons in 2026. Another trend that I want to focus related to a high supply of seaborne iron ore is, look at chart on the left. So chart on the left is our projected iron ore and bauxite exports from Guinea. So as more dry bulks are exported from Guinea, we will see a change in changing demand seasonality for Capesize next year when we consider two factors. Number one, Guinea iron ore supply will complement the bauxite exports, which have consistently achieved yearly growth over the past 10 months. Second reason, when we factor in weather seasonality, typically the rainy season at West Africa from May to October, we'll find that overall export demand will be the strongest in the first and also the second quarter of the year. But by contrast, if you combine the iron ore exports from Brazil and also Australia, it's usually the weakest during this quarter, during the first and the second quarter. So the implication of freight because of a rise in dry bulk exports from Guinea will be ton miles and ton positive, as the strength in Guinean dry bulk export counter the seasonal softness in the iron ore exports from major exporter. However, obviously, there is a downside risk on this. Number one is the political instability in Guinea. And number two is the infrastructure at Guinean ports. So a lot of these that are loading shipments on vessels, they're not deep water ports. So they rely on barges. They rely on transshipment method via barges. So that's more exposed to volatility, especially when they are disrupted by weather. And chart on the right is projected iron ore imports in China. Each line represents 1 year. We think Chinese seaborne iron ore imports will rise by 2% next year to reach closer to 1.3 billion tons in 2026. So I've mentioned that you're aware that Simandou project is heavily driven by Chinese investments. So China, by taking more iron ore supply from the Simandou project, it will have the advantage of displacing high-cost iron ore imports and also the iron ore that they produce domestically. So that's why, even though we'll see a contraction in global crude steel output, the first candidate that will be hit by this will be the high-cost iron ore exporters, and also the domestic Chinese iron ore producers. Now, let's take a look at coal. So, rebalancing Chinese coal demand, this will drive seaborne imports recovery next year. So, chart on the left shows the annual change in seaborne coal imports in major importing countries and also China. Each bar represents 1 year. We expect global seaborne coal imports to improve and rise higher next year by 22 million tons, and this will be driven by slightly more positive outlook in China and also India. So for the Chinese market, the tightening supply of domestic coal production will improve their demand for thermal coal imports next year. So what has happened is the Chinese government has been enforcing tighter control on coal production and also stricter safety inspection at coal mines. So this has resulted in lower coal production this has resulted in lower domestic coal production since July. And at the same time, the displacement of coal within China energy mix will also be slower as China is prioritizing higher utilization rate of the existing renewable energy capacity rather than increasing more renewable energy. Now, for the Indian market, a positive outlook for next year will be driven by the stabilizing demand from the coal power plants that will increase coal imports for blending. So as seaborne coal trade is expected to improve next year, this is also set to improve the Panamax demand, which previously have been suffering from slower seaborne coal trade. And Panamax vessel will be increasing its market share in coal trades at the expense of other vessels. So look at chart on the right. So chart on the right is our Australian coal exports. Each line represents one vessel segment. As you can see, exports on the Panamax in the last 10 months, they have been higher by 9 million ton. But exports on the Capesize vessels have declined by almost twice that number. So this is a very good example of what was spoken earlier on, firmer Capesize market that can also support the smaller vessel. So slower coal trade this year have left more Panamax vessels competing for the same shipments. So as we see coal trade rebalancing, we expect Panamax vessel to take a higher market share in the coal trade. And we also expect Capesize outlook, we expect firmer Capesize outlook next year to also enable Panamaxes taking higher share of Australian coal exports. In the coal market, we will also see several major seaborne coal exporters competing for gaining market share in the Pacific. So chart on the left is the projected Russian seaborne thermal coal exports in terms of destination to Asia and also Europe. I'm sorry if you're at the back, you can't see it, but it's on the book. So Russian thermal coal exports have benefited from higher demand in South Korea because, as you're aware, the government has put less restriction on Russian coal import. But this demand is set to change over the short term because now the government has reinforced the import quota for state-owned utilities that have been importing Russian coal. The positive outlook for Russian coal is going to come from China next year, but Russian coal demand in the Atlantic Basin will see higher competition from Colombia, and especially at a time when coal demand in Europe is contracting. Chart on the right is the Colombian coal exports to Asia and also the Capesize time charter rate for voyage from Atlantic to Pacific. So as you can see, Colombian coal exports to farther destination in Asia is also driven by lower freight rates on top of its own demand, where the decline in Capesize front haul earnings or the time charter rates will push spot voyage rates lower and makes shipping costs cheaper. And more recently, we saw South Korea imports of Colombian coal rebounded, which was driven by lower coal prices after months of being displaced by Russian coal supply. We should expect Colombian and also Russian coal to come into pricing competition in the next few months as they compete for market share in the Pacific. So to summarize for the coal market, number one, global seaborne coal imports will improve and rise higher next year by 22 million tons, which will be driven by a rebalancing in thermal coal demand in China. Secondly, we expect the mid-sized vessel, which is your Panamax vessel, to take a higher market share in seaborne coal trade. And finally, Russia and Colombia coal exporters will see a higher competition for demand in Asia. Let's take a look at the grain markets. So grain carrying bulkers demand have been experiencing changing seasonality because of higher trade volatility. So chart on the left shows the projected US soybean exports for the current marketing year from September to August. So total Chinese purchases in terms of sales so far are significantly lower than what was announced earlier at 12 million ton. And the current sales right now is significantly below the 15.8 million ton that was shipped at this point last year. So if China were to commit to buying this 12 million ton of US soybeans, they have about another 5 to 6 weeks to buy the US soybean shipments until the end of February. But we do not expect China to buy the 12 million ton. We expect it to buy less at 10.2 million ton because US soybean is still expensive. China has only lifted partially of the retaliatory tariffs that it has put, but it still retains 13% on US soybeans. So if China goes ahead with buying US soybeans, the physical shipping of these beans will take place later in the year than usual. And this will be the first time in recent history that we saw demand for Panamaxes rising higher in January. So usually January is one of the weakest periods of the Panamax earnings. And if this buying goes ahead, we also expect Panamaxes to take higher market share in US soybean exports because of the same dynamics that we have seen in coal trades. And chart on the right shows the projected Brazilian corn production for the next marketing year from Feb 25 to Jan 26. For the current market year, I apologize. We expect Brazilian corn production to be slightly lower than last year to just over 120 million ton because of higher domestic demand. For context, the first corn crop is largely absorbed into domestic demand for Brazilian corn ethanol production. And we have seen Brazilian corn ethanol production demand rising higher than last year since the start of the year. And while, in addition, the second corn crop largely caters for export market. And we think Brazil still needs to become more export competitive before they harvest their second corn crop if they don't want to end up with higher ending stocks. So what that means is that there will be limited opportunity for US to export more corn into China as they had been able to do previously. So to summarize our grains market outlook, we expect China to import less than the committed 12 million ton soybeans because China still keeps 13% tariffs on US soybeans. But this means vessel demand will see a seasonal peak in January for the first time in recent history. And secondly, although we see high corn ethanol demand in Brazil, Brazil will still become competitive in the export market, which will put downward pressure on US corn exports for the Chinese markets. We've come to the third section of my presentation. What do I think will happen with our dry bulk carrier developments? So chart on the right is our projected dry bulk fleet growth for vessels over 10,000 deadweight tonnage. We expect a slightly lower growth in 2025 at 2.93% before a rebound in 2026. And secondly, a significant proportion of aging vessels will enter dry docks, and the effect of this will be to tie up supply. And with regards to the ceasefire between Palestine and Israel, the shipping community has been hoping for a normal trading pattern at the Suez Canal. So the effect of this, if this does go through, it will release a lot of vessel supply into the market and push vessel earnings downward. Seasonal rains and weather disruption during the first quarter next year, it presents a challenging risk to Australian coal exports. And finally, the delayed IMO net zero framework. The effect of this is it extends uncertainty around which alternative fuel is the best and cascade the impact also on the new build orders. So chart on the left shows the volume of dry bulk fleet in service and expected delivery based purely on order book. This is not forecast, so it just reflects the number of vessels currently on water and what the shipyard expects to deliver next, in the coming years. So you can see that there was a massive delivery of dry bulk vessels into the market between 2010 to 2012. So these vessels are now aging, and they need to go for periodical special survey as mandated by the Classification Society. So chart on the right shows the proportion of the dry bulk vessels that will enter dry dock until 2027. At least 24% of Cape-sized vessels will be taken off the market next year for dry docking. And the impact of this will be to tie up Cape-size supply at a time when we also expect higher trade growth for the Cape-size market. For the smaller vessels, tighter supply from the dry docking, this will also provide some support, but it cannot offset the structural decline in seaborne coal trade, although we say that coal trades will stabilize in 2026. These are some constraints that has prolonged for, now it's November, so I guess 2 years, correct me if I'm wrong, guys. So the disruption at Suez Canal has been prolonged for 2 years since it's already November now. So chart on the left is the trades through the Suez Canal as a proportion of global dry bulk volume. Each line represents one dry bulk. So I want you to focus on the dotted line. So the dotted line shows the share of trades at Suez Canal as a proportion of global dropped sharply from 7 to 5% between October to December 2023 and have been below 5% until now because vessels are still avoiding the Red Sea. So the recent uptick that you saw was driven by the Black Sea wheat exports. So because many vessels are still taking the longer route via the Cape of Good Hope, the impact of this has been tying up supply, and the effect of this is more obvious on the smaller vessels on the sub-Cape size market. So that is why if there is a resolution, a sustained resolution of or ceasefire between Palestine and Israel, reversing this will release more vessel supply into the market and push down vessel earnings. So we are aware that the ceasefire has been for more than 1 month now, but our in-house view is that we don't think vessels, dry bulk vessels at least, would return to sailing at the Suez Canal until there is a sustained period of stability at the region. Until there is threat over there, higher insurance premiums because of added war risk premium, that will make shipping dry bulk commodities, which is a lower value compared to other commodities, at very uncompetitive rates. So no charterers will want to pay such a huge premium on the dollar per ton basis. And the second reason that is supporting our in-house view is that bunker price has been cheaper. So this also is an incentive for some dry bulk owners to take the longer route via the Cape of Good Hope. But hey, don't take my word. Forecasts right now have been known to be wrong all the time because of the changing in political stability. Chart on the right shows the daily congestion at Australian coal load ports. So the supply chain from coal pit to port in Australia is highly concentrated. So that means any disruption at any point of the Australian coal network can affect the entire system. So this year has shown a very good example. So congestion at Australian coal ports in June this year, it had reached the highest level that we saw since 2017. And this has happened because of the second order effects from Cyclone Alfred. And in May, preceding the event, the Hunter Valley rail network, it was also flooded and has caused a lot of debris that has flooded the entrance of Newcastle port and caused coal exports to halt for a few days at that time. And the last time we saw this level of congestion was back in December 2023, and that was caused by Cyclone Jasper, a train derailment, and also a short protest by the Port of Newcastle. So I just went to Port of Newcastle 2 weeks ago, and I learned a fun fact that now we can start to expect a disciplined seasonal protest at the Newcastle port in every November at this week by the Rising Tide. So the Rising Tide has been doing the same protest and has been in communication with Newcastle port to inform that, hey, we are coming here to do a protest. So the delayed IMO net zero framework has been extending uncertainty around alternative fuels. So chart on the left shows the number of dry bulk carriers running with alternative fuel propulsion. You can see clearly that LNG has been driving the alternative fuel adoption in the dry bulk fleet market at least, and then with a balanced distribution of ammonia and also methanol. However, the wider adoption of alternative fuel is increasingly at risk because of the recent delay in the IMO net zero adoption. Had the IMO net zero framework been voted to be adopted recently, it would have given us a clearer picture on which fuel would return more investment, but that didn't go through. So as a result, we expect to see more ship owners becoming more conscious about placing new vessels running on alternative fuels. So for example, within the global fleet, so that includes all kind of fleets that runs on ammonia propulsion, including those on water and also on order in shipyards, only a quarter of this ammonia fleet are running it as main fuel propulsion, while the remaining 3/4 are classified as ammonia ready. And another example is in the dry bulk market, it is the major iron ore miners who has been the larger investors for ordering dual fuel running on ammonia. But again, a wider adoption of this is being limited because of limited bunkering infrastructure, and not to mention the number of specialized workforce that needs to be trained to manage these facilities. And finally, I would like to summarize why dry bulk fleet growth has been stagnant in recent years by looking at one Capesize market. Chart on the right shows the Capesize asset values and earnings as assessed by the Baltic Exchange. I've indexed them so that we can see the changes since 2023. So you can clearly see that the 5-year-old asset price has been increasing to diverge away from recycling value, which has been in decline. So with time charter rates supporting asset values, Capesize are being kept in the market for longer, which also has an effect on increasing number of aging vessels. And on the other hand, the influx of Chinese steel products into major ship recycling countries have pushed domestic steel prices lower, and that has also lowered the demand for vessel scrapping. And finally, to summarize, number one, the Capesize market has been leading the dry bulk freight market, but the smaller vessels, the sub-Capesizes, they will continue to lag the demand that we saw in 2024. Spot voyage rates remain under pressure because of the decline in bunker prices, and this will continue into 2026. A stronger Capesize market can also provide a floor of support for Panamax earnings, such that when the earnings ratio of these two vessels rises above 2 for a sustained period, meaning the larger vessel is priced at a significant premium for the smaller vessels, we will start to see more demand being induced into the Panamax vessel. Two commodities will drive the market next year, which is higher supply of seaborne iron ore and also bauxite. And we expect coal trade to stabilize and improve in 2026 because of rebalancing Chinese coal demand. The number of bulkers of the market will increase until 2027 as aging vessels enter dry dock for their periodical maintenance. A potential return of normal trading pattern at the Suez Canal will be negative for the demand for dry bulk carriers as it releases vessel supply into the market and push down vessel earnings. And finally, the delayed IMO net zero framework extends uncertainty regarding which alternative fuel is the best. Thank you.
Thank you, Mr. Hanif Kamar, for your insightful presentation. 네, 오늘 하니프 카마르 수석 애널리스트님께서 드라이벌크선 시장 동향과 전망 주제로 발표해 주셨습니다. 여러분, 다시 한 번 더 큰 박수 부탁드리겠습니다. 네, 이어서 오늘의 마지막 발표 8번째 발표입니다. 8번째 발표는 MSI의 아담 켄트 전무 이사님께서 S&P 시장 동향과 전망을 주제로 발표해 주시겠습니다. It's my great honor to invite our last speaker, Managing Director Adam Kent from MSI, and he will deliver speech on S&P market trend and outlook. 네, 여러분 무대 위쪽으로 모셨습니다. 큰 박수 부탁드리겠습니다.
Good afternoon, everyone. Thank you for sticking around. I'll try and keep this relatively short, but will of course include a lot of information as I go through my presentation. So I'm going to be talking about today the outlook for shipping asset prices. For anyone that just doesn't know MSI, or Maritime Strategies International, we're an independent consultancy that specialise in forecasting the maritime markets. We service our clients with a range of products. We offer our forecasting models that forecast right out to 2050. We have reports across all sectors of shipping. We also supply our clients with asset values, current values and forecast values and cash flows associated with those assets, and also strategic advisory and consulting. We cover all sectors of shipping and offshore and a number of the infrastructure in and around shipping too. So enough of the adverts and on to the presentation. And what I want to do today is sort of give you a view of where we think second-hand prices within shipping are today and where will they go in the future and the rationale behind where they are today. And for really to understand that, you have to understand what drives second-hand prices. And the way that we see it is it's a four-piece jigsaw. You need to be looking at all parts of the jigsaw to really understand what is truly driving asset values. At the top end, you have the new building price. The new building price sets a sort of upper reference price, the replacement cost. And I will be talking about where we see new building price today, a little bit about the shipyards, and also where we expect to see contracting volumes coming from in the future and where prices will go. At the bottom, at the floor, we have the scrap price. And I will also talk a little bit about the scrap price and what we need to look out for there. And of course, where we sit between the ceiling and the floor, the second-hand value is therefore dictated by the earnings environment and also the life expectancy of the asset. So to talk about the ceiling, the new building price. New building prices across shipping have been relatively strong, I would say, over the last couple of years, certainly if we compare that to recent history. We can see that for tankers, bulkers, containers, they haven't quite reached the levels that we saw in 2007 and 2008, but they've certainly been very high. We have started to see some of those new building prices soften, I might add, at some yards and for some vessel types and vessel sizes. For the gas carrier markets, we've actually seen a record new building price recently. Now that is partly due to the fact that these assets, whether it be LNG, whether it be the VLGCs or VLACs, are slightly different asset types, slightly different specifications today versus where they were in 2007, 2008. Predominantly, these assets have got a lot bigger over the course of the last 20 years. So what really drives new building prices? Well, to us, it's driven by two fundamental components. At the top, this is just a simple schematic from our shipbuilding model. At the top, what we have is the relationship between the shipyard capacity and new orders at the yard. And that's expressed in our variable forward cover measured in years. And I'll go on to talk a bit more about ordering and shipyard capacity within my presentation. The bottom half of the schematic shows you our view on shipyard costs, what goes into the cost component of building a ship at a shipyard. Now, of course, you have your material costs, whether that be machinery, whether that be steel. You also have labor costs, you have exchange rates, you need to take into account productivity gains. All of that is a vital component into ascertaining what are the true costs to build a shipping asset within a shipyard. If we put that together with the forward cover, that really gives us our view on where new building prices are today and enables us to forecast it going forward. If we just focus in on shipyard costs, and I've just got one side on the cost slide, we can see our view of shipyard costs on the left-hand side, depicted by the yellow line. So shipyard costs have been at relatively high levels. They have come off somewhat from the sort of heights that we saw a couple of years ago when inflationary pressures were really pushing up costs. And one of the reasons that we've seen costs come off has been the drop in steel plate prices. There have been times 2-3 years ago where on a monthly basis steel plate prices touched over $1,000 per ton. Now that's down closer to $600 per ton. And steel plate on average takes about 30% of shipyard costs. So it's a large component and one that we must keep an eye on. But as you can see, we don't expect to see those costs ramp up on the ship's plate side. We will expect to see some inching up on costs more broadly, primarily due to machinery cost price increases and labor inflation. I think it's also important to remember that the Asian shipyards have benefited, I would say, for the softening in the regional currencies versus the US dollar. Ships still, in general, are priced in US dollar terms, and that's potentially great from a profitability standpoint from the shipyards because, of course, they're buying steel, they're paying for labor force in local currency, whether they're being paid in US dollar terms. So that's actually been a huge positive for the shipyards over the course of the last few years from a profitability perspective and helps explain some of the sort of significant returns to the black that we've seen for certainly some of the listed shipyards where we can monitor the P&L. But as we've heard already today, and as we can see on the charts on screen, the shipyards are very full. These series of charts just show you the delivery, the scheduled delivery year, depicted by contract year for the next few years. And we can see that already in 2025, we've sort of pretty much reached where we were at this time at the end of 2024. We've still got more tonnage to come out of the yards, both in November and December. So 2025 will be significantly higher than 2024. But it doesn't stop there. 2026, again, will be another ramp up in shipyard output, if the order books are to be believed. And even in 27, it goes up even further. So, I mean, if you were to go and order a ship today, if it was a large ship, you're probably looking at best bet to get deliveries in 2028. Unless I would say you are very friendly with the shipyard, or unless you wanted to pay a premium to get your ship delivered early. The chart on the right just sort of tries to focus in, I guess, a little bit more on what's going on here in Korea. Obviously, the Korean yards are very dominant within both container, ship construction, and the gas carriers. We can see, actually, we're expecting something of a dip in 2026 before we see a ramp up in capacity, once more output in 2027, along the same lines as we will see globally. So that's what's been going on from a contracting perspective historically. So if we're trying to think about what will happen at the shipyards, where prices will go in the future, we need to try and understand what are the contracting drivers. Are we expecting lots more ships to be ordered at the shipyards over the course of the next 12, 18 months? Well, understanding and trying to measure contracting and forecast contracting is perhaps one of the most difficult aspects of a shipping analyst and certainly a shipping forecaster. And what you can do is you can start bucketing sort of some of the drivers. And that's what I've done here. I've got the more quantitative measures. These are sort of aspects of the industries that we can wrap our arms around, that we can put numbers to, and we can try and measure and we can try and forecast. Where it becomes a little bit more difficult, I must say, is more on the qualitative aspects of what drives contracting. And unfortunately, we are in an industry where there is things like herd mentality. If we see some big players place orders, you may often see other bit players trying to emulate some of the big names within the industry. And everybody, of course, has their own calculated strategy or thinks they have their own market insight. But what I'm going to concentrate on now is just talking a little bit on the cargo demand side, the replacement tonnage requirements, the earnings outlook, and regulations and obsolescence. So starting off with cargo demand. I mean, the factor here is if we're going to need to transport more cargoes, we're going to need more ships. And the chart on the left-hand side just shows us our aggregated seaborne cargo trade growth from 2010 out until 2030. And it's safe to say that we do expect to see continued seaborne cargo growth. The one thing I would say is that cargo growth is going to slow, I would suggest. You're going to see on average cargo growth growing by 1 to 2%, whereas if we look 10 years ago, 20 years ago, we'd have seen cargo growth growing more like 4 to 5%. So it's growth nevertheless, it's just slower growth. And if we try and break that down into some of the key sectors, as the chart on the right shows, we can really see where the strongest growth will come from a sector perspective, very much so in the chemicals and the gases side, and not so much in things like the oil tanker sector, where as we sort of move towards the end of the decade, we're actually forecasting negative cargo growth for the oil tanker markets. And we've heard a little bit about this today, and I think it's a very important point, so I don't apologize for repeating for something what we've already heard. Cargo growth only tells us part of the story. What we really need to do is take that cargo growth, the cargo moving from A to B, and translate that into how many ships we need to service that cargo, whether that be in tons, whether that be in cubic meters, whether that be in cars, whether that be in container boxes. And by that, what I'm saying is what we need to do is build in the inefficiencies and the efficiencies within shipping to really understand the true demand for shipping tonnage to service global trade. And this is something that we spend a lot of time doing at MSI, and we have a simple schematic of MSI's forecasting methodology on the left-hand side of this chart. And it's by no mistake that trading efficiency sits front and center within this model schematic. And what we're trying to do is not only understand the trade, but the routes that those cargoes are moving on, the distances that those trades are performing, the speed of the assets, the waiting times outside of port and in port, operating days. Ships don't operate 365 days of a year. You know, you do have to go in for repairs, you have to go in for surveys, you have to go in for retrofits potentially. Ballast ratios also play a big part in terms of optimization. You can cube out on certain cargoes, although the stipulated deadweight capacity may be 50,000 deadweight. If you're taking a light grains cargo, you may only be able to fit in 40,000 deadweight. And when it comes to forecasting, again, you then also have to be baking in evolution in vessel sizes to really understand this idea of fleet efficiencies. And of course, efficiencies have always been within shipping. They've always been there. The demand for ships has always been greater than the cargo growth rate. But since COVID, I would say, we've really seen a ramp up in these inefficiencies. And of course, the big inefficiency that we're currently seeing within the industry is the deviations around the Cape of Good Hope rather than going through the Red Sea and the Suez Canal, which, as we've heard today, is drawing in a lot of additional tonnage, and it means that the cargo is moving on a lot longer distances. This is just from a screenshot from our new product, MSI Seascape, which basically is an operational benchmarking tool. You can look at where vessels have been trading, how they've been trading, and the efficiencies of individual vessels and how they compare to their cohorts, along with green credentials, CII and emissions, and asset values. And just to sort of really ram home this message and how important it is to look at these inefficiencies within the system, what I've done is I've put together two examples of supply-demand balances. The chart on the left-hand side, the y-axis shows you fleet growth, year-on-year fleet growth, and the x-axis shows you trade growth or cargo growth, just flat cargo growth. Now, of course, if we see fleet growth higher than trade growth, that's a negative for fundamentals and negative for market balances. And that's why we can see all of the sectors last year would have been in this red shaded area, i.e. this was not a good sign for market balances and for earnings. However, if we take that simple fundamentals and we translate that into, rather than trade growth, we look at shipping demand growth, factoring inefficiencies, and we take fleet growth and we actually look at available fleet growth, taking into consideration time spent in shipyards for repair or surveys, or even when a vessel is delivered on the 31st of December. You shouldn't necessarily be, you shouldn't be counting that as a vessel that's traded for 365 days of the year. You should only count that as one day. Basically, if you look at the fundamentals expressed in these two metrics, you get a very, very different picture for what went on in 2024. And it helps explain the strength that we saw in the market last year versus if we just looked at it from a headline fundamentals perspective. So demand is certainly there. There's also a requirement for replacement tonnage. It's quite striking. The chart on the left just shows you, just across the whole of the global fleet, the average age of ships on the water today is over 15 years old, which is miraculous, I think. In an age when we're trying to have more eco ships, we're trying to reduce emissions, we're trying to have new technology on board vessels, the average age of a vessel on the water is 15 years old. Even for dry bulk, containers, tankers, the big three, it's around 13 to 14 years old. So we're dealing with a very old fleet. And that's even, if we look at the chart on the right-hand side, which gives us a little bit more of a breakdown of the age profile, we can see significant volumes of vessels over 20 years old that are still trading, and certainly for some sectors, vessels over 25 years old. So there is a demand for new ships to be ordered. As we've heard in things like on the container side, perhaps the demand isn't for the largest vessels, but more for the smaller vessels on the container side. And I would say that that's something that we'd also say for the tanker sector and also for the dry bulk sector. When it comes to earnings, this is one of my favorite, it's a favorite chart that people like to see, because what we're just trying to do here is sum up where we think the market is from an earnings perspective, where each individual sector is on its own earnings cycle, and the relative strength of one sector versus another. We can see a lot of sectors of shipping, conventional shipping, on the left-hand side of this infographic, and what that means is that earnings are lower today than they were 12 or 18 months ago, and we do expect to see some softening going forward. For many of the sectors, the fundamentals still remain relatively robust, but earnings have been softening. We can see LNG. LNG has passed the bottom of the market cycle. The market cycle troughed in the end of Q1 this year. It's not going to race up to record highs anytime soon. It will be a continued gradual recovery as more land infrastructure catches up with the vessels on the water, but we've passed the bottom of the market cycle. If we continue to the right, we can see tankers. Tankers have been given a shot in the arm recently by the additional production of oil from OPEC, and a lot of economies, especially China, now stockpiling this oil, which is why we're seeing such strength for the VLCC market. And at the top of the earnings cycle, we have the very stubborn containers, which refuses to budge, as we've heard earlier. They have been sat there for some time, and we think they will sit there certainly for another 12 months. And some sectors of offshore. I mean, the thing with offshore, it's very much down to the individual assets. It's also where those assets are trading. You have very different dynamics in Southeast Asia versus Latin America versus North Sea versus the Middle East. So you really do have to sort of look at the regional market balances to understand where the true demand is for offshore. And even at today, even though we're starting to see some softening in earnings, there is profitability, there is money to be made from shipping. The reason I say that is this chart, the stack bar, just shows you break-even levels. And by break-even, what I'm talking about here is debt service, so the amount that you're having to pay your bank or your lender, the daily operating cost, which is the yellow part of the stack bar. So that's your break-even level. And the red horizontal bar, or red horizontal line, is the one-year TC rate. So as long as there's a gap between the break-even and the one-year TC rate, that means there's cash in the system to pay equity, to pay shareholders, or potentially to reinvest into new tonnage. Regulatory pressure, although there has been some wobbles, will continue to come thick and fast. CAI is, of course, here to stay. We're not entirely sure what the trajectory will look like post-2026, but I think one thing's for certain, it's going to be a little bit more, there'll be more of a steeper decline in the trajectory beyond 2026. And as we can see from the fleet, if we look at the fleet breakdown, there are a lot of vessels trading by looking at our indicative positions, a lot of vessels trading at sort of grade E, D, or E, i.e. these vessels either have to go slower if they can, they either have to change their operations, or there will be an incentive for the owners to scrap these vessels and order more tonnage. But as I alluded to, and as others have also alluded to, the delay in the IMO midterm measures, the net zero framework, for at least another 12 months, I think will cause some people to sit on their hands yet further, delay any difficult decisions while new building prices are still quite high, while there's still an uncertainty in terms of what fuel type to go for. And I think people will just wait to see what happens with those vessels that do hit the water. Will they be able to secure fuels at a low enough price to make them economically viable? So I do think that this is a great thing for a decarbonisation standpoint, because I think it's delaying a lot of people's decisions within the industry in terms of new contracting. So where do we think new contracting will go, given everything I've just said? Well, this is a depiction of contracting by vessel type over time. We've measured this in compensated gross tons, just to sort of even the playing fields between the different asset classes. And we can see 2025 is going to turn out to be a year on par with 2023 and 2022. Not quite at levels that we saw last year, which was the second highest level since 2007. We do think then there will be something of a go slow on contracting in both 2026 and into 2027. We can't see any new sector that's going to be demanding new tonnage that hasn't already been at the shipyards. If you go through them, containers, LNG, cruise ships, LR2s, VLCCs, we've seen near record ordering for all of those asset types over the course of the last few years. The real asset we think is missing within the contracting framework that we've seen over the last few years is the dry bulk sector. But I would say that dry bulk is probably one of the last to come to the market with the alternative fuels, given the tramp nature of the vessels, given the lack of pressure from end user to decarbonize supply chains. So that's on the contracting side. For that forward cover dynamic, we also need to think about shipbuilding. And this remains one of my favorite charts that we produce at MSI, which is in and around the evolution of shipyard capacity by shipyard nation. And the reason it's one of my favorites is just because it still is eye-opening just how quickly shipyard capacity grew from the first decade of this millennium. Going from around 20 million GT to over 100 million GT in almost the blink of an eye. Shipyard capacity is very elastic, and we can see that historically from this chart. You know, when there aren't orders, shipyard capacity is closed, shipyards manage their capacity, they turn their attentions elsewhere. And we can see that currently we're in a sort of a boom period once more for shipyard capacity. That has been the reactivation of mothballed yards. That has been, you know, some yards moving from operating 2 8-hour shifts back to 3 8-hour shifts. And that has been, in some cases, the startup of greenfield yards. I think what's interesting as we look forward is that we do think that further shipbuilding nations will start taking greater market share off of China, off of Korea, off of Japan, and off of Europe. Of course, the US has sort of garnered a lot of the headlines in recent months with the new USTR 301 and the Ships for Americas Act. But we've also heard strategic announcements from other governments. Governments like India, Vietnam, the Philippines, Brazil have all stated now that shipbuilding is a key strategic industry for them, both, I think, from a merchant shipping perspective, but also from a naval perspective as well. And we expect to see more and more of these shipyards come to fruition over the course of the next 20 years as we move to the middle of the decade. So where will prices go given all of this? Well, as I say, we expect to see a lot of deliveries coming out of the yard over the next 3 years. We don't expect to see huge volumes of contracting. And as we can see on the chart on the left, what this will mean is the order book will fall. When the order book falls, we see this reduction in the yard forward cover metric. And we can see on the chart on the right, there's a very good relationship between yard forward cover and new building prices. And the proxy here for new building prices is dollar per CGT. It is almost a great linear relationship, one of the better ones you're going to find analyzing shipping data. And as you can see by the big circles with the white insides, we do think this forward cover metric will fall over time. So with the yard forward cover falling, which on the left-hand chart is depicted by the green line, we can see that we do expect costs to sort of inch up marginally over the course of the next few years, but new building prices will fall off. And that's probably most easily seen by the chart on the right-hand side, which depicts our view of new building contract prices over the course of the next few years. Now, I would say that although they are going to fall, we would depict this as a softening of new building prices. If we look at the position even in 2029 and we compare that to the most recent history, we can see that 2029 is comparable to 2022. And I think if you were to ask the market in 2022 where new building prices were on how healthy they were, I think most people in the room would say that they were relatively robust in 2022. We've just gone sort of up above and beyond where we thought that they could go over the course of the last 3 years. So it's a softening and not a collapse. So that's where new building prices are going. So we've sort of set the ceiling. Now we're just going to talk by one slide about the floor, the scrap price. Now scrap prices are from a long-run historical perspective, relatively healthy, around $400, $450 per LDT, depending on where you're going to scrap your vessel, whether you're going to scrap it as a Hong Kong yard or a non-Hong Kong sanctioned yard. We do think scrap prices could inch up marginally over the course of the next few years, but it's not going to sort of get back to those levels where we saw, as I say, plate prices get to $1,000 per ton, and we saw scrapping prices get to above $600 a ton. So there is some support from the scrap price for those older assets. The thing is that we just need to keep one eye on, as we've heard a little bit about earlier, what's going on in the broader steel industry. No longer are ship scrap prices dictated by ship scrap volumes. They are pretty much solely dictated by the wider steel market. And we've tried to depict that on the chart on the right, which shows you the relationship, the R squared value over the time periods depicted on the x-axis, the relationship between scrap price and steel plate prices, which is the yellow line, and scrap price versus demolition volume, which is the dark blue line. And if we look at the 1980 to 2024, the R squared is virtually zero, whereas if we look at the scrap price versus steel plate price, between 1980 to 2024, the R squared is 0.95. So a very, very strong relationship there. So we need to keep an eye on what's going on in steel production. That usually means we need to keep an eye on what's going on in China. So we've done the ceiling, we've done the floor. Now we need to find out where the price will fit between the two. And by this, we need to look at earnings. And the way that we do this at MSI is that we look at earnings, we forecast earnings, and using our supply-demand models. And what you can do in different periods of the market, you can relate earnings to different shapes of depreciation curves at any point in time. And we have to take in consideration, when we're looking at the depreciation value, what we also do is we normalize for movements in new building prices, and that the equation on the top right just shows you the simple equation that we use. We have to normalize for movements in new building price, and we also net off the scrap price, because as we just heard, the scrap price is just dependent on the steel price. It's not part of sort of what's driving shipping. And what that enables us to do is derive a family of depreciation curves. And as we can see on the chart on the left, which is net replacement value depreciation for VLCCs on an annual average basis, you can see a whole different family of curves. So when the market's very soft, you see a big sag in the depreciation. When the market's strong, you see depreciation tend towards straight line. And it's a huge variability. If we just focus on 10-year-olds for VLCCs, that has moved between 25% depreciation of a 10-year-old versus net replacement value, right up to almost 80%. So a huge variability in those curves depending on the earnings environment. And if we look at in a slightly different way for a Capesize on the right-hand side, which shows you the 10-year net replacement value expressed against the net earnings over time, you can see there's a very good correlation, a 0.94 correlation coefficient between this concept of net replacement value and earnings. So this is how we really need to look at earnings to really understand where second-hand asset values will sit. So where do we think earnings are going to head? This is sort of taken from the end of our modelling process of supply and demand at MSI, where we're now looking at incremental supply and incremental demand for bulkers, containers and tankers. We've inverted the supply growth just to make it a little bit easier on the eye, i.e. big supply growth is bad for market balances, whereas small supply growth is good. And as we can see, after this year, for all the main sectors, we expect to see some softening. Tankers, as we'll remember from one of those first, the earnings infographic, we do think has got probably another 8 months of strengthening, given current market dynamics, but we do expect to see a softening in employment rates due to predominantly a slowing in demand and a ratcheting up in supply across all these sectors. That then means taking the employment rate one step further and translating that into the one-year TC rate. We can see that the chart on the left is our forecast for the one-year TC rate. We can see that, again, we expect to see a slide down in the one-year TC rate for pretty much all sectors of shipping. Again, for many sectors, this is just a softening, and even for the 8,000 TEU container ship, which does look, it does sort of make you, when I say softening, you do think, well, that doesn't look like it's softening, it looks more like a collapse. But again, it's only sort of getting back to the sort of levels that we saw in 2023, which, you know, markets, the charter market was still doing relatively well. But given the supply side, it's somewhat inevitable that that market is going to face some downward pressure. And if we sort of compare those earnings on the chart on the right to the 10-year averages from the 2010s or what we've seen so far in the 2020s, we can see our view in 2026 still remains pretty much above anything that we've seen in the last decade. If we move things a little bit further and we look out to 2028, this is just a simple box and whisker plot. The box and whisker plot just shows you the historical distribution of a variable, and here we're looking at the one-year TC rate. The red circle shows you where currently one-year TC rates are, and the green circle shows you where we expect one-year TC rates to be in 2028. And for the majority of sectors of shipping, although the green is below the red, the green sits at or above the historical median. The median is depicted by the horizontal line within the box. Containers is a little bit different, and that's because this data goes back to the mid-1990s, and I would say that the container industry now is a very different sector than it was in the 1990s. In the 1990s, it was sort of more of an adolescent sector. It was still evolving, still growing, and today we've sort of got a more liquid, we've got a more evolved, mature market. So what are our outlooks for second-hand values? Currently, second-hand values, I would say, are quite toppy, quite sticky. This just shows you the development of second-hand values for a range of shipping sectors. We can see the red line has generally been, which is the evolution in prices during the course of this year, has been at or above that historical average. And even for LNG, as I say, we saw record lows for some sectors of LNG at the back end of Q1 and into Q2 this year. The asset value didn't move a jot. So I'd say that the asset values still remain pretty sticky, certainly for the dry bulk sector. But I think it will come as no surprise. I've spoken about a decrease in the new building price, scrap price sort of staying there or thereabouts, and a softening in earnings. So it should come as no surprise that we do expect to see second-hand values come off from current levels. One thing that we are also seeing is S&P volumes. It's a very different type of volumes depending on what market you're looking at. And I think on the tanker side, I think the high asset prices do mean that people are considering whether they want to buy at today's prices, given where prices are at today and whether they may be in the future. Container ships, you know, the liner companies are crying out now for small tonnage, so they're, and obviously a wash with cash, so they don't mind buying these smaller vessels, and that's why the sub 3,800 TEU vessels have been dominant in the S&P transactions and in containers. Dry bulk, even though prices are high and earnings are potentially at break-even levels, because we've not seen new ordering, the next best thing that the dry bulk owners can do is go out and buy good, modern, fuel-efficient second-hand tonnage. And that's one of the reasons I think that second-hand prices have kept up higher than you would expect in this sector, and it's also borne out by the actual S&P volumes that we've seen over the course of the last couple of years. And I think with the LPG sector, I think there has been something of a realization that that all of the vessels, the VLGCs that have been ordered at the shipyards, may not be required, especially because a lot of them have been built as VLACs, the very large ammonia carriers, and we're starting to see quite a few pullbacks in green ammonia production plants all around the world. So we're not going to need the 90 or so of these vessels that are being ordered. So I think there's some reticence generally within the LPG market currently, given ongoing dynamics. So as I said, it should come as no surprise that our view is that we do expect to see a softening in second-hand values over the course of the next few years. This is just a distribution of 10-year-old prices over history. I've marked off where second-hand prices are currently today for the 6 sectors displayed in yellow, and the red bar is where we expect them to be by the end of 2028. Now the red bar, again, is always to the left of the yellow bar, but I've also put the median and the mean values for these 10-year-old asset prices on each of these charts. And although we are seeing this movement left or a softening in the second-hand values, pretty much in all cases, the second-hand value will remain at or above historical medians and historical means. All of this sort of data can be extracted from the MSI models. This is just some screenshots from our FMV product, which from an individual asset basis will give you our view of new building prices, second-hand values, the one-year TC rate and operating costs. So you can do a lot of interesting analysis on historical performance, on our forecast view, and also looking at individual asset cash flows. So that's everything that I had to say. Hopefully there was something in there that you found interesting, and thank you all for your attention. Thank you.
Thank you very much for your informative presentation. 네, 여러분 다시 한 번 더 큰 박수 부탁드리겠습니다. 네, 이렇게 오늘 2025 Kobc 바다 컨퍼런스 모든 일정이 끝이 났습니다. 한국해양진흥공사는 2018년 첫 번째 컨퍼런스를 시작으로 올해까지 변함없이 대한민국의 해운, 조선, 물류, 금융산업의 현안을 함께 고민하면서 글로벌 해양산업의 미래를 모색해 왔는데요. 올해 바다 컨퍼런스 또한 산업계를 비롯한 많은 관계자 여러분께 뜻깊은 논의의 장이 되었기를 바라보겠습니다. 앞으로도 한국해양진흥공사는 더욱 내실 있는 주제와 또 깊이 있는 논의를 통해 바다 컨퍼런스를 지속적으로 발전시켜 나갈 것을 약속드리겠습니다. 오늘 이 자리에 함께해 주신 여러분들 꾸준한 관심과 참여 부탁드리겠고요. 바쁘신 가운데 참석해 주신 모든 기관 여러분들께 다시 한 번 더 감사 인사드리겠습니다. 조심히 돌아가시길 바라겠습니다. 아나운서 정재희였습니다.